In today's video, we've got something big. We're talking Tom Lee, Cathie Wood, and Kevin O'Leary, three of some of the biggest names in finance, all weighing in on what's coming next for crypto, for blockchain, and how this new wave of on-chain finance could be about to crash straight into Wall Street. Because let's be real, we've been talking about going on-chain for over a decade. It's been this idea floating around since the early Bitcoin days, but it never actually happened at scale. Now suddenly the momentum is here, and what's fueling it? A brand new wave of incentives and regulation, the kind of environment that's actually pushing traditional finance to start building on the blockchain. This isn't theoretical anymore. People are actually using blockchain as a digital payment system. And when that happens, you don't just talk about crypto. You have to transact on crypto. That means going on-chain. This isn't financial advice. Now, here's what's crazy. For the first time ever, this shift isn't being driven by hype. It's being driven by utility. The same institutions that once called crypto a bubble are now building payment systems on Ethereum, Solana, and yes, even XRP's ledger for cross-border settlements. But here's the thing. When everyone rushed on-chain this weekend during that sudden volatility spike, the system got jammed. Ethereum, the second biggest blockchain on Earth, the network that's supposed to be the future of digital payments, literally froze. It got overloaded. Think of Ethereum like a one-lane highway with a toll booth. Each car on that highway is a transaction. Under normal traffic, no problem. But when volatility hits, when billions start moving through, all those cars are lining up, honking at the toll gate. And if you've got money to spend, sure, you can cut the line. You can pay a higher fee to get through faster. But over the weekend, some people were paying over $1,000 just to send a transaction. Imagine buying a $2 coffee and having to pay $1,000 in gas fees. That's not scalability. That's chaos. And this is where the story comes in. Because while Ethereum and Binance were both choking under volatility, something very strange happened with XRP. Before we get into that, if you want to actually understand how the top 1% of investors are positioning themselves for this exact transition, how they find asymmetric opportunities like XRP before they explode into mainstream attention, that's exactly what I break down inside the XRP Millionaire Blueprint. It's a complete guide with a document, infographic, and video showing how the smartest investors are positioning right now for this once-in-a-generation shift in global finance. You can find it in the pinned comment below this video. Now, let's talk about what happened. Over the weekend, XRP dropped all the way down to $180, and then within hours shot back up to $233. That's not normal price action, especially not for an asset that just cleared one of the biggest legal hurdles in crypto history, the SEC case. Not to mention, multiple spot XRP ETFs have officially been accepted for further review by the SEC, something that under the old administration would have been almost impossible. And now with Gary Gensler out of office and new legislative frameworks coming in that actually favor digital assets, you'd think XRP would be exploding even higher. So why isn't it? It comes down to two words: market manipulation. And I know that sounds obvious, but this isn't about some hidden conspiracy. It's about structure. The average investor, you and me, we can't move the needle. We buy a few $1,000s worth of XRP, the whales move hundreds of millions. And when those whales, or even more importantly, the exchanges, decide to move their supply, the entire market reacts instantly. Here's what I found. When digging into the blockchain data, the top 100 XRP addresses, the biggest holders, were not selling during the crash on October 10th. In fact, many were accumulating more XRP. That's critical because these wallets aren't random traders. They're institutions, exchanges, and in some cases, Ripple itself. For context, Ripple owns the majority of the top 10 wallets. Binance holds several as well, which makes sense because they act as custodians for user deposits. But when you look deeper, you see that none of these major wallets made big sales on October 10th. The last significant on-chain sale we can trace to Binance was on September 22, 2025, when they offloaded around 70 million XRP. That's a big move, and that's the kind of transaction that can single-handedly push the price down short-term. But that wasn't during this crash. That was weeks earlier. So if the top holders weren't selling on October 10th, who was? It points back to internal exchange wallets, the ones the public can't see, because exchanges can operate off-chain internally. They can transfer or dump holdings without it immediately showing up on the public ledger. And if they're holding massive XRP reserves, even small adjustments in those wallets can swing the market. That's why you see sudden drops without any logical explanation, while fundamentals are stronger than ever. And here's where it gets even more interesting. Ethereum, as we said earlier, got jammed. Binance saw stablecoins temporarily lose their dollar peg because their exchange couldn't handle the volume. That's a huge issue for trust. Meanwhile, XRP's network kept running fast, clean, consistent. So, when volatility hits and Ethereum gas fees spike through the roof and stablecoins start losing peg on Binance, what asset keeps settling transactions seamlessly between banks and institutions? It's XRP. That's what's so important about understanding this moment. While everyone's staring at short-term price charts, the underlying infrastructure battle, the one between old finance and new finance, is being fought right now. Ethereum's scalability issues are still there. Bitcoin is sound money, but not fast money. XRP, on the other hand, is the one asset designed from day one for institutional payments. And now that the legal cloud is gone, it's moving closer and closer to fulfilling that original vision. And that's why you'll keep seeing moves like Cathie Wood and Tom Lee talking openly about the next phase of blockchain adoption, because they're not looking at meme coins or trends. They're watching the rails of the future financial system get rebuilt in real time. When Cathie said, "This is the year Wall Street and regulators finally became open to rebuilding on blockchain," that wasn't just commentary. It was a signal. The stablecoin market is exploding. ETFs are being greenlit, and the barriers that kept institutions from touching crypto are being systematically removed. Tom Lee went even further, predicting Ethereum could reach $60,000 in a world where Bitcoin hits $2 million. Now, whether or not those exact numbers hit doesn't even matter as much as what it represents. Massive institutional belief that crypto is here to stay, not as a fringe play, but as the base layer of the next financial revolution. And every time that belief grows, it benefits XRP. Because XRP isn't trying to compete with Bitcoin. It's solving a different problem: instant, frictionless, global payments. That's why you're seeing the tone shift from crypto is risky to crypto is infrastructure. And XRP sits right at the intersection of those two worlds, between decentralized blockchain tech and real-world financial utility. So when Ethereum's toll booth clogs up, when Binance can't handle the heat, when stablecoins start wobbling, XRP just keeps moving value from one end of the stuff world to the other in seconds. And that's what most investors don't see. They get caught up in the price swings, the noise, and they miss the foundation being built underneath, because the biggest players aren't reacting to the day-to-day charts. They're accumulating slowly, methodically, the same way they always do before the next leg up. And if you go back through the data, the same pattern keeps repeating. When retail panic sells, the whales accumulate. That's not speculation. That's verifiable on-chain behavior. And the October 10th data proves it. Again, these top wallets didn't sell. They added, because they know what's coming next. And they know exactly how fast sentiment can flip when the broader market catches up to what's already happening behind the scenes. The real capital rotation forming under the surface right now isn't about which coin is trending on social media. It's about where the infrastructure money is going. Because when Wall Street finally decided to step into crypto, they didn't come for quick trades. They came for control over the rails, the systems that move trillions every single day. And that's exactly why you're hearing people like Tom Lee and Cathie Wood saying this is the most important year for blockchain in over a decade. Not because of speculation, but because the rules of the game have changed. Regulation no longer means restriction. It now means validation. Tom Lee put it best. This is the year Wall Street and governments actually became open to rebuilding on blockchain. And you can feel that shift everywhere, from stablecoin policies to ETF approvals to the new frameworks letting institutions hold crypto directly on their balance sheets. For years, crypto was seen as the enemy of traditional finance. Now it's quietly becoming the operating system for it. Cathie Wood doubled down on that idea in the same discussion, pointing out how stablecoins have become the breakout use case for digital assets. She called them the bridge asset between legacy finance and decentralized rails. And she's right. Stablecoins are the test run, the warm-up for what comes next. Once the system proves it can handle trillions in tokenized dollars, the door opens for tokenized everything else. Stocks, bonds, commodities, and cross-border payment systems like XRP that make it all flow seamlessly. That's what most people don't realize. The entire narrative around crypto has flipped. It's no longer, will this replace the dollar? It's, how fast can we tokenize the dollar and move it on-chain? And once that happens, you need rails that can handle enterprise-level volume. You need speed, liquidity, compliance, and low cost, all at once. That's where XRP's architecture comes in. It was literally designed for that moment. Now, back to Tom Lee's interview. He went deep into what's next for the market, saying he believes this cycle could propel Ethereum to $60,000 per token and Bitcoin to $2 million. Those numbers might sound far out, but his reasoning is clear. He's basing it on adoption, not hype. In his view, this isn't just a bull run. It's the start of an institutional migration, and the math checks out. MicroStrategy, which holds hundreds of thousands of Bitcoin, is sitting at around a $100 billion market cap today. But Tom Lee made the point that if Bitcoin hits $2 million, MicroStrategy becomes a $2 trillion company, purely because of the value of its Bitcoin holdings. He compared it to an oil company. The oil itself is the asset. The infrastructure around it magnifies that value. So in that world, Ethereum's decentralized apps, or dApps, become the new tech infrastructure, and Bitcoin becomes digital property. And where does XRP fit in as the transactional bridge that moves value between all of them? Kevin O'Leary added another perspective that's just as crucial. He said he believes the reason institutions have been slow to fully adopt crypto isn't because they don't believe in it, it's because of uncertainty. The second that regulatory clarity arrives, the floodgates open, and we're starting to see exactly that unfold right now. You can see it in the ETFs. You can see it in the legislative hearings where lawmakers are finally separating blockchain innovation from speculative trading. And most importantly, you can see it in the way financial infrastructure companies, from Visa to PayPal to Fidelity, are integrating crypto rails into their systems behind the scenes. This is why the short-term volatility doesn't matter to the people who really understand what's happening. While retail traders are panicking about daily candles, the world's largest companies are laying down the pipes for an entirely new financial network. That's why Cathie Wood and Tom Lee both sounded so confident in their projections. They're not betting on meme coins or trading patterns. They're betting on the system itself evolving. Now, think about how this connects to XRP. Again, Ethereum's biggest weakness, as the market saw this week, is its scalability under pressure. The toll booth problem, $1,000 gas fees spiking past just to move a transaction. That's not sustainable for enterprise adoption. Binance saw the same issue. Massive volatility causing some of its stablecoins to dip from the dollar temporarily. In contrast, the XRP ledger handled its volume with zero downtime. And that's what's quietly winning at institutional respect. Because if you're a global bank or a payment processor moving billions per day, you can't afford network congestion. You need reliability. When you look at the data, that reliability is exactly what's being rewarded. Behind closed doors, banks and fintech companies are running pilot programs on the XRP ledger, testing settlement systems that bypass SWIFT entirely. The numbers aren't public yet, but on-chain transaction counts tell the story. Volume is up and settlement times remain instant. That's why the temporary price drops don't reflect the reality of adoption, because adoption doesn't move price overnight. It builds pressure beneath the surface until it finally erupts. Think of it like what happened with Bitcoin years ago. For almost a decade, it traded under $10,000. People called it dead hundreds of times. But while the price moved sideways, infrastructure was quietly being built. Exchanges, custody services, derivatives, ETFs. And then one day, the market caught up to what was already true. The system had matured. That's the phase XRP is in right now. Legal clarity is there. Institutional curiosity is there. The use case is proven. Now it's just a matter of liquidity catching up to utility. And Tom Lee's optimism about Ethereum reaching $60,000 comes from that same logic. Once institutions have a clear pathway to allocate capital into crypto assets without regulatory friction, the inflows will be enormous. We're talking pension funds, sovereign wealth funds, major corporations, entities that manage trillions. When even a small percentage of that capital moves into crypto, it changes everything. Bitcoin benefits first. Ethereum benefits second. And utility-based networks like XRP benefit most in the long run because they're built for actual transaction flow, not just store of value narrative. That's the long-term view. And that's exactly what people like Cathie Wood are focusing on. She's not just investing in tokens. She's investing in the companies building the infrastructure for those tokens. So while retail traders stare at the price charts, wondering why XRP isn't reacting faster to good news, the real players are accumulating positions quietly and building out systems that will eventually require XRP liquidity to operate. Meanwhile, Ethereum's congestion issues prove why diversification in blockchain infrastructure is so important. You can't have the global financial system running on a single network that freezes when traffic spikes. That's why interoperability is becoming the next big theme connecting Ethereum, Bitcoin, XRP, and other ledgers into a unified global system. Kevin O'Leary made another great point here. He said the next trillion-dollar opportunities will be in the companies that make digital assets talk to each other. That's the kind of thinking that gives XRP an advantage because its technology was built around interoperability from day one. It's not just about moving XRP itself, it's about moving value no matter what form it's in. And when you look at what the International Monetary Fund, Bank for International Settlements, and major central banks are discussing right now, digital currencies, cross-border settlements, liquidity bridges, you start to see why this all lines up perfectly with XRP's long-term mission. This is the kind of macro shift that doesn't happen overnight, but when it does, it redefines wealth distribution. The people who understood the internet in 1995 became the billionaires of 2020. The people who understand blockchain infrastructure in 2025 will be the ones holding asymmetric positions when this system fully activates. So, as the dust settles from the October volatility and Ethereum, Binance, and Bitcoin all adjust to their new realities, keep an eye on what's being built quietly in the background. Because while most investors focus on prices, the top 1% focus on positioning. And right now, that positioning is moving toward assets that solve real problems: speed, settlement, transparency, and global connectivity. That's where the next major wealth transfer is setting up. And as we'll see in the next section, the people who've been watching these patterns longest, from Tom Lee to Kevin O'Leary, are now aligning their forecasts with one unmistakable conclusion. This next crypto cycle won't just make headlines, it'll reshape the entire financial system. This next crypto cycle won't just make headlines, it's going to redefine how global finance operates. Because for the first time, we're not looking at a speculative wave. We're looking at the foundation of a new financial era, one where value moves as easily as information, and where blockchain technology becomes the invisible layer connecting everything. That's what Kevin O'Leary meant when he said, "You're going to see every single asset on Earth become tokenized." He wasn't exaggerating. He was pointing out the direction the world is already moving. Governments, corporations, even central banks are exploring how to take what already exists, currencies, securities, commodities, and put them on-chain. And when that happens, the real winners aren't the ones chasing coins for short-term gains. They're the ones who own the rails, the infrastructure that moves all that tokenized value from one place to another. That's where XRP comes in. Because the value moves digitally, the more demand there will be for seamless, instant cross-border settlement. Right now, the legacy banking system can take 3 to 5 days to clear an international transaction. That's fine when you're sending $500, but when global trade operates in the trillions, those delays cost billions every year. XRP solves that problem. It turns a multi-day settlement into seconds. That's why the big players are watching closely. Ripple's partnerships with banks and payment processors are expanding quietly behind the scenes, and each new integration increases XRP's long-term value proposition. It's not about hype, it's about efficiency. The same way they replaced fax machines, XRP's technology is replacing outdated payment rails. Now, combine that with everything Cathie Wood and Tom Lee have been saying. Institutional adoption is coming faster than anyone expected. Regulation is catching up. ETFs are being approved. Stablecoins are gaining global trust. And in that environment, assets that combine compliance with utility are going to dominate. Ethereum will continue to serve as the decentralized app ecosystem. Bitcoin will remain the digital gold, the ultimate store of value. But XRP's role is different. It's the connector, the bridge between networks, between currencies, between financial institutions that all need to move value faster, cheaper, and across borders. And here's what's fascinating. While retail investors panic about short-term price swings, the top wallets, the real whales, are quietly accumulating. On-chain data doesn't lie. The biggest XRP holders weren't selling when the market dipped. They were adding, because they understand that by the time the mainstream realizes what's happening, the early positioning window will already be gone. It's the same pattern that's played out again and again in every major shift. In 1997, few people believed the internet would power global commerce. In 2008, few believed mobile apps would become trillion-dollar industries. Now, in 2025, the same disbelief surrounds blockchain infrastructure, and that's exactly where the next wealth wave will be born. That's why Kevin O'Leary said the next generation of millionaires will come from digital asset infrastructure, not from trading coins, but from owning the systems that power them. It's about ownership of the networks that move money, the liquidity that fuels markets, and the rails that connect the global economy. As blockchain and digital finance grow, the real wealth will come from those who build and control the foundation of this new financial system. The focus is shifting from speculation to structure, from guessing prices to owning the technology that makes the entire ecosystem work. And make no mistake, the governments of the world are watching this too. Central banks are testing digital currencies that need efficient settlement layers. The IMF and BIS are already talking about interoperability frameworks. Guess which technology checks every box on their list? Speed, compliance, scalability, and real-world adoption. XRP. So, as the market evolves, as old systems merge with new technology, And as value finally becomes as mobile as information, the focus will shift from what coin will pump to what network will run the system. And XRP has been quietly preparing for that role for over a decade. You can feel it in the interviews. You can see it in the data. You can hear it in the tone of people like Tom Lee and Cathie Wood, who understand that this isn't just another cycle. It's a global financial realignment, a digital reset of how money moves. And while that transformation plays out, the smartest investors aren't waiting for mainstream confirmation. They're already positioning, methodically, deliberately, in the assets designed to survive regulation, scale globally, and integrate with the world's largest financial institutions. That's where XRP fits in. That's why the biggest holders aren't selling. And that's why every dip keeps getting absorbed by accumulation, because they understand that once the global liquidity migration begins in full force, the assets with real-world use cases will be the ones that rise fastest and last longest. So, as the narrative continues to shift and the next phase of this market unfolds, remember, history doesn't reward the people who react. It rewards the people who position early. And the positioning window for this next financial era is closing faster than most realize. Now, if you want to understand exactly how top investors are positioning themselves for this next phase, how they identify major opportunities before they go mainstream, that's what I break down inside the XRP Millionaire Blueprint. It's a complete high-level guide that includes a document, infographic, and video showing the precise framework the top 1% are using right now to prepare for this global financial shift.